I see from your notes that you like Chinese stocks and you even expect the Chinese currency to appreciate. Is that despite all of the geopolitical tensions between China and the West?
Yeah, we are positive on Asia and Japan, and the reason why is linked to fundamental factor. I mean, when you look into the earnings growth, when you look into valuation, and you compare valuation to the rest of the world, and thinking essentially to U.S., this equity remains still very attractive. When you have such geopolitical noise, you know this political noise brings some volatility into the market, but doesn't disrupt the trend. So overall, we believe that this trend will continue to be positive. There will be some volatility. Markets will rebounded very quickly since March low, but it doesn't mean that fundamentals are not improving. On the contrary, the economic data is quite strong in China, in the rest of the region. We have seen the PMI, we have seen export and import, which are also improving, also meaning that the rest of the world is doing better than before. And clearly, this is supporting that part of the world. And then when you also think about an alternative to U.S., that's the only place in the world where you can find a big, giant tech is in Asia. So clearly, we believe that Asia market is attractive, supporting there is a supportive recovery in the economy, but also fundamentally speaking, the earnings picture is quite positive for next year. For instance, we are expecting more than 80% EPS growth, while this year was almost flat. So clearly, it's one of the regions which is quite resilient to what is going on in the rest of the world.
Well, and it's also much cheaper than Europe or the U.S., Claudia. It's pretty shocking when you look at the PE ratios on the S&P 500 or on the Stock 600. I mean, they've just absolutely taken off with the U.S. trading at, I think, 26 times earnings, and even Europe trading at 22 times earnings. Aren't they overvalued?
So this is, thank you for asking that, because this is a question which I've been asked by clients since a while, and my answer is that one. One, when we look into multiple expansion now, we should take into account that the earnings part, is falling down quite quickly. So what we are expecting is multiple expansion to be supported by excess liquidity. As I said before, there is a huge, strong correlation between excess liquidity and multiple expansion. The real rate and never been so low. So clearly, the fact that you have negative real rates in every part of the world, that is also supporting the multiple expansion. Then another reason why multiple expansion is so big and may continue for going forward is when you compare the upside of equity to another asset class, you don't have a lot of asset classes which are delivering positive expected return for the coming 10 years. Clearly, if you look at longer term and you don't look at the coming 3 months, with the sovereign rate to be at zero, globally speaking, you don't have an alternative to equities to make a positive expected return. So there are multiple factors which continue to support the multiple expansion.